The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Welcome, everybody, back. Another episode of the Apartment Gurus is coming at you right now as we speak. And, today is one of those count your blessings sort of episodes in that we get to have Shannon Robnett back on the show. He's a repeat guest for us. Shannon is a entrepreneur extraordinaire based in Boise, Idaho. Been 20 in the real estate world for 27 years, developer and syndicator, really an expert in new development, as well as just in the multifamily space in general. You can check him out at shannonrobnett.com. That's 2 N's and 2 T's at the end. So Shannon, dude, welcome back to the Apartment Gurus. It's really good to have you again.
Tate, I appreciate the opportunity to speak to your listeners again. How have things been?
Yeah. Things are cooking. We're busy as can be. We've got 2 deals that we're getting down to the deadlines on and putting the final touches on capital raises. And
awesome.
I'm eager to delve into that whole world with you. I know that you've been very successful in that space and have a lot of experience there to share. But I was looking back through and couldn't. It's been a second since you were on the show, and
I think it's been about 1.5 years or 2 years.
Yeah. So get us up to speed. What are last time you were really focused, as I remember, pretty locally on some essentially mostly new builds, if not exclusively new build type projects. Is that still your focus? And kind of catch us up, Shannon.
Yeah, well, in the last couple of years, we've obviously expanded our portfolio. We're now from Washington State to Florida. We have done, when we talked last, I was primarily focused on new builds because that's what made sense. I've been in the game for 30 years almost. And for me, there's investing requirements that have to happen, and cheap money kind of changed a lot of that. The froth, the foam in the water, the FOMO, all that kind of stuff really changed what people were willing to do to get a deal under contract for them. But it never changed our underwriting. It never changed the stance we took. We've always been investing 30+% of the equity in deals. We've been coming across very strong with our development projects. We've had fantastic exits. And we've always kept the same mentality that, if it's a good deal, it's a good deal, but it has to meet certain requirements. We're not willing to change our requirements to have a deal. And I think we're seeing a lot of syndicators and a lot of investors in general are having issues because they let FOMO get ahead of the spreadsheet and they made emotional decisions instead of ones that are just based in, numbers and logic.
Yeah. Well said. And so lots to unpack there. Let's just kind of start with your expansion from, going somewhat local in our last conversation, regional at least. I know you had experience in other markets, but to Washington to Florida, that's going big and in all directions there. So I guess a couple questions. I know Boise is a very, very unique market. Idaho in general is, the municipalities and cities in Idaho are incredibly unique in the sense that depending on when you look at them, they're often the fastest growing places in the country, right, per capita. And there's obviously the supply demand factor going on there, makes, it's definitely put a lot of upward pressure on housing costs. So my question is kind of like, did Boise change some or shift some in terms of how it aligned with your investment criteria and overall thesis, and cause you to want to look elsewhere? Or was it just a matter of kind of wanting to have more to pick from and scale up?
Well, both of those reasons are good ones. I mean, we were looking at it going, okay, we're needing to deploy more capital. Not that Boise couldn't handle it, but Boise did change. The first thing that goes up is costs, right? Then the second thing that follows that is rents. And the last thing that follows that in any economy is wages. So Boise, during the pandemic, went from a $74,000 annual household income to $96,000, right?
Yeah, wow.
That's a tremendous jump in wage increase. And with it, upshot costs, we imported 67% Californians of the people that were coming in. So they had, much lower expectations for what they could buy, right?
Right.
And so we saw prices go screaming up. But one of the other things that we've always looked at, Tate, is to make sure that we're investing in great markets. I'd rather do a good deal in a great market than a great deal in a good market. I mean, there's parts of Chicago, it wouldn't matter what the cap rate is, you wouldn't want to invest in it.
Right. For sure.
And so, back to kind of like what Warren Buffett says about a rising tide floats all boats, I would rather have the Houston market lifting up my project than try to go in there and make my investment in Houston lift the Houston market. Right. And so
for sure,
we began to look at things that were coming on the horizon with, the fact that we had 3% interest was phenomenal, but it wasn't permanent. We knew that, anybody that had been in the business for a while knew that this was going to change. And what other factors come with that? With rising interest rates comes inflation. What happens in inflationary markets? Markets slow down, markets change. And so we really went back to our fundamentals of looking at what makes this market so awesome that we want to invest here. Mm-hmm. And we have about 9 markets across the nation we're working in. Mm-hmm. All of them are very strong economically that give us the comfort level to know that we will always have solid investments in those areas, regardless of what interest rates do, regardless of what our national economy does, regardless of what national employment does. And so we began to look and expand. We've now got deals in Florida. We've got deals in Houston. But we also looked at the asset classes that we're investing in. We were, last time we spoke, we were very heavy into multifamily. Mm-hmm. My background is in industrial and commercial outside of multifamily. And so I kind of went back to those roots because in inflationary economies, industrial is an incredibly strong asset, right? You've got a tenant that's got a balance sheet. They're signing 3 to 5 year leases. To move is very expensive. They're not going to do that for $50 on the monthly rent. So all of those things led us back to look at that. And we've acquired industrial deals in Florida, industrial deals in Texas. We're looking at North Carolina as well as Tennessee for both multifamily and industrial. But we've really just kind of gone back to making sure that our fundamentals stay strong. And when you do that, Tate, it really doesn't matter what economy you have. You're going to be putting together solid investments that are going to be beneficial for the long haul.
Right. And even better news is, like, if 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 Shannon Robnett has a deal that pencils and projects well, and you can get it to perform in this climate, then any improvement in climate obviously is going to vastly benefit the asset, the performance of the asset, the value of the asset. Obviously interest rates come back down somewhat or soften, or whatever they do. Cap rates, obviously maybe compress a little bit again. That's all. Of course, I'm sure you're not underwriting that to happen anytime soon. Neither are we. But that's all upside that is potential that could be realized.
Well, yeah. I mean, you have to understand, Tate, when I did my first investment deal for myself in 2001, I think I was borrowing money at an 8.5% interest rate, and my exit cap was a 9. Right. And so for me, I've always, every time we bought a deal, I never anticipate selling that deal for a lower cap rate, or even the same cap rate I bought it at. I'm always projecting 1.5-2% higher on my cap rate when I'm exiting, because just like we've found out again in the last 12 months, we've seen cap rates move almost 2 full percent.
Yeah. We've also seen unbelievably historically high interest rate hikes. You're looking at percentages, right? Like record setting, obviously. So
absolutely record setting interest rate hikes, but we're still at half the interest rate that my dad started his investing career. Right. I mean, he was building houses and borrowing money at 16 to 19%. Right. Yeah. So it can get worse.
Sure.
And how are you protecting against that?
Right.
So.
Yeah, and that's a rabbit hole that you and I could easily dive down.
But we only have 40 minutes here. We don't have 2 days, right?
I know you and I would both be happy to go there, but I think today we've got some bigger fish to fry, and I don't know if it's an elephant in the room right now, but the big factor that I'm seeing across the board in my space and in the 2 masterminds I'm in. Actually 3 masterminds if I include mine, and Facebook groups and all, really like the zeitgeist, if you will, is that raising capital is just hard right now. And so I love that, Shannon. I love that look you just gave me. That's awesome. I mean, because you're gonna offer a contrary view to what I just said, and I really appreciate that. And I can't wait to hear your response, but maybe I'll recontextualize it a little bit. Like, it's harder than it was a year and a half ago or a year ago, right? Sure. Just because it was such a hot, positive cycle at that point. So things have shifted, but share with us why, for in your world, Shannon, like, it's not necessarily hard or harder, or what's working well for you there?
Tate, again, you go back to what my normal is, right? I mean, the cycle that I've been through in real estate is obviously a long one. And I've had periods where, I went through the .com bubble burst, right? And what it took to get people to do deals then, went through, 08 and all of that. And, trying to get somebody to do a deal in 9 and 10 was like pulling teeth. So when I look at what it takes to get capital raised now, again, our primary focus has not been to raise capital. Our primary focus has been to educate. Out of that education has come people's understanding that, well, this is actually a good deal. This actually makes sense. Why, I can do this deal. I can work with you. I can, and we've had a lot of people that we've educated that have done deals with other people. And I'm completely fine with that, because I don't want someone in my deal that doesn't understand the deal. So instead of just trying to convince somebody out of Silicon Valley that's making, $350,000 a year that they need to do X, Y, and Z, and they go, okay. I want to make sure that that person out of Silicon Valley understands exactly why and what is going to transpire when they do this, so that I've educated them to really eliminate all the questions I'm going to have over the next 3 years, 5 years while we're doing this deal, because they understand it. And when people understand it, look, Tate, if you're producing cash on cash day one, if you're producing tax benefits out of your deals, if you're producing appreciation out of your deals, it's pretty easy to make that sale or to educate someone on why this works, because you're not saying, hey, you got to trust me because, we're going to do this deal and then we're going to do this and we're going to do this. And we're going to pull these levers over here. And in 4 or 5 years, we're going to see some results, know? And so where a lot of people that were getting involved in real estate 36 months ago were looking at it that, hey, we're going to buy this deal. We're going to do a value add. The bank's going to loan us, 85% of the money. Once we're done, we're going to refinance out. We're going to get you all your money back. I've come from a longer cycle than that. We've always been a 5 to 7 year projection on all our stuff. And so when people are looking at this going, hey, we're 3 years into this deal, we're still looking good. And I go, man, we're looking amazing, right? I mean, rents have gone up. Cap rates have changed a little bit, but not different than our underwriting. And so for us, that continued performance, I mean, we were looking at it the other day, Tate, and we have a 99% reinvestment rate, right?
Wow.
I mean, we
99%.
99%,
That's
and
incredible.
That's because we've educated people instead of sold them. Right. And so we've helped you understand the real estate journey. So they may be talking to another syndicator and they may be investing with other people. We have a lot of people that invest with multiple, right? And we love that. But when they understand why this deal is good or why this deal is better or why this deal fits their portfolio, right? I mean, we work with a lot of high income earners. They could care less about making money today. The only thing that they care about is how much tax benefit can I get them, right? They're working their butt off today to make enough money to be able to put themselves in a position to retire early, and that's their only goal. So trying to get them into a cash flow deal doesn't make sense for them. Trying to get them to max out their IRA so that they have self-directed money might make some sense from a tax point of view. But being able to educate them so that they truly know and understand that they are doing the best thing they can do for themselves makes all of this very easy. So now it's just about continuing that education process. And, currently we're seeing probably, I would say, 7 to 9 new investors come into our system on a weekly basis, right? Now, that doesn't
probably mean almost 100% word of mouth is my guess, right?
No, not entirely word of mouth, but there's a lot of that. But the reality is when they come into our system, they're probably 90 to 120 days from an investment decision, right? So they're coming into our system for the education. So it doesn't really feel like they're, hey, I met you, today's day 31, guess what I get to do? I get to pitch you a deal, right? It's more of that, what questions can I answer for you? Can I hook you up with a tax advisor? Can I get you with an RIA that understands asset protection and cash flow and, other things? Can I place you in an ecosystem where you're finding answers to things? Because Tate, there's nothing makes you look smarter than being able to refer people to smart people, right?
Yeah.
And to be able to solve problems that they didn't even know they had builds trust in a phenomenal way and incredibly quickly. And so really what we're looking to do is completely educate you, the investor, on what you think you're wanting, because a lot of investors think they want one thing, realize that they really want another based on understanding what happens there. And so I think for us, we've been able to continue to pick up speed, not only because of our track record, because of our education, because of how we process the whole system, how we break it down that, I may or may not have a deal right now, but I'd still love to talk with you. I'd still love to get you involved. I'd still love to get you connected with some great tax strategists and those kinds of things so that you can make the best decision when the time comes for both of us.
Awesome stuff, man. Again, lots to unpack and all of that. But the overarching theme there is value add education, like adding
Absolutely.
tons of value to your prospects' lives and financial lives. And you probably don't even refer to them as a prospect. They're probably just your network, right? Like,
yeah, absolutely. I mean, your network is your net worth, right? It reminds me of when my son started, he's fifth generation in real estate, right? And when he was trying to figure out, Dad, how do I, I'm 21 years old, I think was when he got his real estate license. How do I impress people at 21 years old? I said, well, there's two things you got to do. Number one, you got to be the sharpest dressed person in the room. Mm-hmm. So he was always in a 3-piece suit, right? Wow, yeah. And then secondly, you've got to have an answer for every single question someone has. That means you've got to build a toolbox full of resources so that I don't care if they need a plumber, a hairdresser, a mechanic, or a realtor. You've got an answer for all of that so that every time they turn around with a question, you can connect them with a reliable resource so that now they always know that the first person they call, in fact, hopefully the only person they call about anything, is you. And that's the same model that I've built my companies, is to make sure that I have that answer or that connection, right?
Yeah. How old is he now, Shannon?
He's getting ready to turn 27. So
okay.
Yeah, he's done
6 years later. And how's he doing in real estate? Is he's still in real estate?
Doing phenomenal. Yeah. I mean,
nice.
In fact, we've got 60 units of apartments going right now, and he took it clear through the whole entitlement process, found the project, brought it to me. I underwrote
Excellent.
it, put together a plan. He took it through the city and the county and got all the permits and all the approvals. I mean, kid's just killing it, right?
Good for him, man. Good for you. Good for both of you. I'm sure that's got to be incredibly gratifying for you and exciting for him. And, that's really cool stuff. Okay. So let's just I'd like to get maybe just a little more granular on this education piece, because it really seems to be a huge part of like the tip of your spear, so to speak, and kind of something that really a force in your business that really moves the needle along. So what is it? What does it look like to you're attracting people through your ecosphere? These sorts of appearances. Your own podcast. I know you have meetup groups, et cetera, et cetera. Just social media presence. You're great on all of that stuff. So you're attracting people that way. What's the experience like for somebody that kind of flies by your system and engages and jumps into your ecosphere? What is it? What's it look like from that point forward?
Well, the first thing we want to do is we want to know what you're looking for, right? Mm-hmm. I mean, everybody says, you hear all the time, you hear Robert Kiyosaki, you hear, all these different people talking about real estate's the way to wealth, or, even Dave Ramsey, as much as he's against debt, he still talks about investments, right? Mm-hmm. And so we really try to figure out, what kind of investor are you, right? Mm-hmm. Are you looking for cash flow? Are you looking for appreciation? Are you looking for tax benefits? And everybody without fail says, I want all three. And I respond with, I wanted to be 6'8" and playing in the NBA, but look what happened, right? Mm-hmm. So let's get realistic. Which one do you need? And then we began to educate them on how to get what they want, right? So if you're looking for tax benefits, you're making $300,000 a year, life is fine, but what you realize is that you're going to constantly have to put in that 60 to 80 hours a week until you decide not to get that cash flow. How can we maximize your ability to take advantage of things that are going to propel you forward and get money to work for you and not give it to Uncle Sam in the interim, right? Yeah. And so then we begin to educate them on that. And then if that's their primary focus, they really begin to understand that. We get them, usually we have some connections with some great tax strategists that can really dive into what is your business and how do you make your money and how can you shelter that money from paying taxes? And then once you take it, put it in investments, how can you work on that even further? And, beyond the 1031 and the bonus depreciation, there's so many other levers to pull. And then when they start to see and understand that, then they start to go, okay, well, wait a minute. Do I want to put all my eggs in one basket? Maybe I should know more about appreciation. Maybe I should know more about this. And we just continue that education process. And I've got some great people that work with me that do that from a subcontractor point of view, or a contact that we can put them with. But I also have some great staff, because you can't be all things to all people. And so having great people that can help people answer those questions and get that education and take the one-on-one time and get them newsletters and get them, information on a consistent basis that shows them that not only do we have the knowledge, we have the contacts and the reach, they really begin to build that trust. Because as you know, Tate, people do not invest with you unless they know, like, and trust you, right? And once you've got them to understand that you're looking for their best result, not yours, because not every deal fits every investor. If you're looking totally for tax benefits, a development deal is the worst thing you could do. There's no tax benefits there. You get great appreciation, but if you're in the highest tax bracket you could possibly be in, the last thing you want is more appreciation.
Right.
You'd be better off with cash flow rather than appreciation, unless there's some tax benefit to that. And so we really just kind of start that process, and it's almost like a mini mentoring, right? Because you're helping them to understand why they want what they want. And like I said, about 60 people that even come into that ecosystem don't really want what they say they want. But after we've educated them and we've helped them to understand these are the benefits of these different things and this is how it works, they then begin to understand, oh, now I know what I want. And oh my gosh, this makes me feel so much better, because they totally change their attitude because they understand what they're investing in, right?
Yeah, you've done so many things there. You've instilled a sense of confidence in them because they, like you said, they get what they're doing, right? They don't feel like they're, like at a Mexican birthday with piñata, just like blindly swinging in the air, hoping that something connects, right? Which is how I think probably a lot of people feel when they start out looking at being a passive investor in a real estate deal. They probably feel a little bit like a fish out of water unless they're coming in with some real estate experience or whatever.
Tate, let's take that one step further. If they're investing in a stock market or with your typical mutual fund guy, they feel the same way. Right. Oh, I'm going to put you in 60%, growth fund and 40% equities, and we're going to sprinkle in some of this. And they're like, okay, if you understand what you're doing, I get it. And then they get their statement at the end of the day and they go, what the hell happened? Why didn't I make any money? Hey, this guy said he had it figured out. That's the last thing we want to happen. We want people to really know and understand why this is a good investment based on their need. And then, then people aren't swinging wildly. They know exactly what to expect. They can look at what's coming out in our information and our newsletters and our on-site cameras and all that kind of stuff. And they can truly understand that we are on track. We're a little bit ahead. We're a little bit behind. And they're able to really continue to build that trust and understand that, yes, I'm in a good investment, right? Yeah. Because your mutual fund guy, he gets you in, he gets your money, he gets everything done. And then he meets with you. He only wants to meet with you once a year to go over things, you know? Right. And you don't understand, hey, the market's up 30%. Well, yeah, but the thing that we did for you was betting the market was going to go down. They don't know. They just don't know. And there's so many times when people do that with investments in general, and then they can't figure it out. And then they just get disgusted. They go, well, I'm not going to do that anymore. I'm going to go try this. But they still don't understand what this is or what it does. Right.
Yeah. So you've just like massively empowered the investor with knowledge and, the leverage knowledge and the leverage experience that you have. They're leveraging your mistakes over the course of 30 years.
And there's been plenty.
All the resources. Right. Of course. And all the resources you have and all the relationships you have. And then another thing that you're doing, Shannon, that it just keeps smacking me in the face when I listen to you talk about it is you're creating raving fans that can go out and like convey your message, right? Because they understand it. They're like, they're like, here's what I'm doing. They go to their friends. They're like, this is the coolest thing ever because they understand it. Yep. They can explain it. They can convey the value and create referrals. That's why why I went immediately to, I bet most of your new investors are word of mouth, because what you're doing in adding the kind of value that you're adding to people, like it creates word of mouth referrals. It
does. And, I've got one investor that comes to mind. This guy is referred. I think his original investment with me was like 140 grand. And he's referred over $8 million worth of money to me. Right.
Yeah, wow.
Because we did exactly what we said we were going to do. Right. And we executed on it. And this guy didn't need a ton of education. He still appreciated the ecosystem, but he also understood that, here he could take his friend, that's somewhere else in the world and can refer him, and Shannon can educate him instead of me having to educate him. And then that person goes, well, not only did, he refer me, but man, I'm really getting my questions answered here. We're building trust even faster. Then they've referred people. And we've just really been able to track just this one guy to about $8 million. And it's been through that education process and people just feeling like they're heard, they're understood, and they feel comfortable with that investment they just made.
Yeah. Okay. So, I'm stalking you here, Shannon, online. I'm on shannonrobnett.com /webinars. So, which is of course under your resources tab. You've got, you've got links to construction cameras, your YouTube channel, 2 different ebooks, webinar series, a number of different webinars actually. Are these kind of the assets that you use, the deliverables that you use?
A lot of them, yeah.
People,
But on top of that, there's a lot of self-learning, but we'll also take the time to educate you directly. If you need connected to an expert, we do market studies. I think we've done 8 or 9 markets that we've looked at, and the ones that we've found to be successful for us to invest in, we've done a webinar on it. Right. Mm-hmm. So, if you're looking at Nashville, Tennessee, go look at my webinar. Don't bother doing the research. You can double check it, but man, we've scoured that. We've talked to local brokers. We've talked to local investors. We've dealt with property management companies out there. We've really plowed into that market and got the great information so that you could just literally go do your deals in Nashville based on the information that we did. I think it's probably 60 days out of date is all, and really save yourself a lot of time. But a lot of people, Tate, they didn't know they needed this data to make a decision, right? Mm-hmm. So they're able to look at that and go, oh, wow, that's the level of information I need to be able to pull the trigger on something. Right. Because this is what they're coming up with. I would need that information to do something with it, right?
Absolutely. Absolutely. And another adage that comes to mind and kind of listening to you go through this is whatever the opposite of a confused mind says no.
That's right.
Is like
that's right.
An informed, enlightened mind that understands the juice and how things work will say yes to opportunities. And
I've even taken time and gone through the underwriting through my spreadsheets and how we build it out. And I've gone through that with people that want to know. It's not just the one sheet and, the PPM and those kinds of things. I'll literally take you step by step through my spreadsheets. Yeah. So that you can see where I put this together and what links to this and how that market study then relates to the information that goes in the spreadsheet and how, national trends would affect that and how we've kind of, how we built in the back door for this and our plan B is right here and plan C is over here. And here's the moving parts and here's how these things change so that people can really understand that, hey, you guys know what the heck you're doing. Right. And I could go reinvent the wheel or I can invest with you guys because you understand that and you've built that in and you've actually hired a person and that works with you that is full-time in financial analysis of deals. You've actually hired a person that their full-time job is to go out and find loans, and we've compared 8, right, that are willing to do the loan on this deal. And we've got the best one for our strategy for that deal and show that to anybody that wants to see it. Right.
Yeah. Doing, again, just creating tons of value. And, I was just at lunch with one of my best friends that got me started in real estate in 2006. He was one of my first mentors and
first dealer, huh?
yeah. And he's actually still kind of in the single family space, and I'm always working on him for that. But because he's a major leaguer, he's just kind of playing in the minors right now. But we were talking about, this is a value add economy right now, and really, I think not just right now, but especially it seems to like commercial real estate, especially, and the space I'm in multifamily, just is such a highly relational space and very not transactional space, right? Absolutely. Like the folks that are doing, big things year after year after year for 30 years, like you, Shannon, are relational people that understand, people first, right? Like, you put those relationships first, put the deals second, the opportunities second, and just how can you add, like, if you really, really put that person, in your case, an investor coming into your ecosphere, if you put their needs and priorities first, what does that really look like? Well, of course, it looks like getting into their world and understanding what those needs and priorities are first and foremost.
Absolutely. Well, and look, there's been plenty of people that I've told them this deal isn't right for you, right? Mm-hmm. This isn't what you're looking for, and either I'll plug them in with another syndicator, or we'll look at something different. But the reality is, when people feel like they matter, it changes that relationship. And like I said, I've got people that have been investing with me for even back when it was single check writers. They've come along for the ride on the syndication journey, right? Mm-hmm. And so I've got people clear back from 2009 that are still investing with us, right? That find the value and know that this isn't something where you've got to get to know somebody else. I mean, how many of us go to the same doctor because it's not just convenient anymore? We're now driving clear across town, but that's my doctor. Right. That's the one that knows me. That's the one that has helped educate me about my health and my, whatever conditions I've been working through over the last 20 years of aging. Right. And so we see that. And a lot of times people don't treat real estate or investing in general that way. They treat it as transactional, and their business reflects it.
Mm-hmm. Sure. Yeah. Just kind of thinking outside the box here a little bit, I guess, Shannon, what, or maybe inside the box, this could just easily be answered inside the box. I think 30 years is a few lifetimes in this business, right? I mean, it has nothing to do with age. It's just a lot of cycles. It's a lot of different looks at the market, up cycles, down cycles. Between 2010 and 2013 or 14 was totally flat, right? Yep. So you've been through all of that. Like on the capital side of things, what are you doing that's just kind of fundamental? Like, just dribbling the basketball, practicing free throws kind of stuff. Kobe Bryant in the gym for 5 hours at a time. What is it that you do that you've been doing for years that you would attribute a lot of your success to?
Well, I think the fundamentals of underwriting haven't changed, right? I mean, you may be buying at the peak of the market. I mean, I sold a deal, 180 unit apartment complex. I sold it at a 3.6, right? I think that was the official numbers. It was sub 3.75, right?
Wow. Yeah.
And we redeployed into what at the time was a 5.75, right? So we're picking up the spread. Now that 5.75 is expanded to maybe a 6.25 cap. but so have our rents. Our rents have gone up, I think 21% versus underwriting, right? And so what we're really looking at and what we're going back to is it's got to make financial sense. It's got to cash flow. You've got to be able to get to a number that works. You've got to have 2 or 3 exits, opportunities. You've got to have, plan A, a plan B, and a plan C, but you've always got to look at the market getting worse, right? You've got to look at debt going higher. You've got to look at vacancy going up. You've got to look at how do you come through this? And what a lot of people have been doing over the last couple of years is finding out the bank says, hey, you need 17% total equity in this deal. We're still going, we'd like 30, right? Because that's a level of protection. Maybe we've always been looking at interest reserves, right? During COVID, everybody started pumping interest reserves. We didn't have to because we always have interest reserves. We always think about a 7 or 8% construction contingency, not just a 5. We always look at what happens to this property with a 10% vacancy. Where are the places that we could get into trouble? And it's not always rosy. In fact, I would say that I'm 60% pessimist, and I used to be 80% optimist, right? So you've just learned that what is it? If you fail to plan, you plan to fail, right?
Right.
And I think part of that planning is planning. How does this deal fail? How does this deal fall apart? How do we wind up in trouble on this so that we can try and close every door and barricade it with a plan for that? And you can't always be doom and gloom. I mean, my goodness, that'd be a horrible life. But at the same time, we're continuing to underwrite. Look, if we're buying it at a 5, we're selling it at a 6.5. If we're financing at, if we've got a finance option at 3% for a 5-year or 4% for a 10-year or 5% for a 20-year, we're going to take the 20-year, right? Because the reality is I would rather look you in the eye and my underwriting said we could do it and make you, 20%. I would rather look at you and go, I did that with 20-year fixed money and we sold it in 2 years, but I had us covered for the next 2 decades, right? Because there's a lot of people that got into deals in 21 and 22 that are now, whether they like it or not, are going to be in them for the next decade, right? Because that's what it's going to take to dig out. There's other people that are going to lose and they're going to be out of the deal before they ever get to the refinance part because they didn't plan for the kind of things that have happened.
Right. Yeah. Yeah. So you feel like a lot of people feel like the distress is still ahead of us largely.
I've talked with a lot of people, and if we compare it to baseball, I think we're in the 2nd inning. Right.
Wow.
And the reality is I don't think we're going to have a crash. I mean, I know of a couple of syndicators that have executed their business plan flawlessly, absolutely flawlessly. They raised rents to $200 or $300. They did the improvements. They hit their budgets. They hit their timelines. Everything went perfect. But now their DSCR has got them needing to bring another 15% or 10% equity to the table, which means they're re-underwriting their deal, which means they've got to go back and disappoint their initial investors. Whereas if they had brought more capital to the table at the beginning, sure, they wouldn't be returning as much capital, but they would still not be going out for more capital. Right. I mean, let's just take $100 million deal, right? You bought a $100 million deal. You came in with 20% down and your cap rate went up 1%. And then the bank's looking at your DSCR, your debt service coverage ratio, needing to be a 1.25. And so now all of a sudden the bank's going, we can only loan you 65% of the money. Well, if you had brought 35% to the deal initially or 40% to the deal initially, you may not like that, but you're not having to go out and re-raise money, and you can slide over this point in history and get to 2 or 3 years down the road when I think inflation is going to continue to keep rents superheated, maybe not 15% heated, but 8 to 12%. And you're going to be able to get over this hump where a lot of people just hit it like a wall and there's no way around it because they brought in the minimum and there's no way through it. because now they got to go either raise more capital, sell the deal at a loss, whatever they got to do. It's not pretty.
Right. Yeah. It's not comfortable. Yep.
No, it's not comfortable, like hugging a cactus.
Right. Yep. Well said. Yes. Okay. Just great stuff, man. And it's your perspective is just hugely valuable. With your not only your 30 years of experience, but just kind of what you're up to in the market. Given the market and kind of where you guys have gone portfolio wise and asset class wise, are you looking to continue to do more industrial type projects? Are you is that shifted for you at all? What's what's next for you guys, Shannon?
Our focus has not changed. We are in these 9 markets to do deals. If we can make sense of a multifamily deal right now, we'll do it. If we can make sense of a industrial deal, we'll do it. And I got to tell you, that deal has got to start with cash flow, right? Mm-hmm. We've got to be able to get cash flow day one. We've got to be able to have distributions in the first 90 days of ownership, or it's not something we're interested in. Because again, going back to building belief and trust, if I can give you money in 90 days, it doesn't matter if it's, let's just think about a 6% cash on cash or a 5% cash on cash on $100,000 is going to be like $400 and change. But it's the fact that you got it just like we said you were. And that's what real estate investing is all about. So you get your cash flow, you got, everything that is on that PPM, everything that's in that one sheet is being checked off and being delivered. And so we're still seeing a disparity between buyers and sellers, obviously, in what they think their stuff is worth. But we're still looking at it. And when we see deals that underwrite well, we're still doing them. We just took down a deal in Houston about 4 months ago. We assumed some 4% debt. But man, that thing's just, it's like clipping coupons, right? So whether that's industrial or multifamily, even some other select commercial, we've done an office deal. We're probably not thrilled about office in general, but you know what? There's definitely markets where office is undersupplied in the nation right now.
Yeah. Yeah. Salt Lake City is one of those, I think.
Exactly. Boise's another one, right? We've got all the brand new stuff that's at $38 a foot. And we've got the stuff that's just absolutely all original 1970 that's going for $15. And there's a need for that $22 to $27 stuff. And we love that market.
Yeah, for sure. And then kind of last but not least, just to round us out here, moving forward with on the capital front, on, raising equity, just kind of slow and steady wins the race here, stick to the plan. For you, is that how things are looking?
Yeah. And Tate, always under promise and over deliver. If you look at my deals, most of my deals project a 14 to 17% return. I'm not out there trying to show people that I'm going to get them 31%, or I've seen some come through at 27, 28. If you can do it, great. Underwrite it the most horrible way you can to get to that 14 to 17 and then shine like a diamond,
Yeah. Good point. Yeah. Like if you've got that strength of a deal, like don't show your cards to your investors. Show. Yeah.
Just make sure
under promise, over deliver.
Yep. Absolutely.
Awesome stuff. Shannon, what's the best way for listeners to connect with you, interact with you, learn from you, et cetera?
Just like you said, Tate, ShannonRobnett.com. It's pretty easy. All my socials are there. You can connect with everything there. My calendar's available. If you want to book a call, chat further. We're really here to serve the investor and get them the knowledge that they want so that they can make the kind of investment decisions that they need to. Yeah.
And I'll just add, Shannon's a great follow on. You're way active on LinkedIn, if I'm not mistaken.
Yeah, LinkedIn, Facebook. I'm not, but I have. We've got a great presence there. Yeah. It's gotten to the point where if I was doing the socials, that's all I would be doing.
Right. Yeah. No doubt. Yeah. It's a lot, right? There's a lot of aspects of this. So, it's tough to be famous and successful sometimes.
Well, when I get there, I'll let you know, Tate. I'm not either of those yet.
I appreciate it. Let me know. Awesome. Shannon Robnett, ladies and gentlemen, this has been so good. Shannon, really appreciate you. And looking forward to having you on again in a year or so and circling back on this stuff, because I think there's just tremendous value in everything we just covered. So really appreciate it.
Well, and I appreciate what you're doing too, Tate. I mean, I know what it takes to do a podcast. I know all the effort that goes into it, and it's a pretty selfless journey because you really are taking the time to put information out, to educate people, to help them on their investment journey. And I just want to take my hat off to you, buddy, because I know that it's definitely a journey of love, but it's also a little bit of madness has got to be mixed in there because of the amount of effort it really truly takes.
Yeah. I'm very lucky. I've got an incredible team that produces this thing for me, and they make my job way easy. And I just love it. I truly love it. Like you said, love is definitely the word. So, I appreciate all that very much. Got a lot of gratitude. So, and listeners, you guys make it all just way, way worth it and make it fun. And I love hearing from you. I've been hearing from a lot of you guys recently. Let's do this together. There's lots of ways that we can work together and be connected, whether that's one-on-one coaching, just down to being on a 10-minute Zoom call sometime and getting our heads together. Love to connect. So investwithgreenlight.com is the best way to reach us. And again, it's Shannon Robnett with 2 T's at the end of his name, and shannonrobnett.com is where you'll find him. So thank you so much, everybody, and we'll check you on the next episode.
This has been The Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of The Apartment Gurus.